All right, you guys see this?
Yeah.
All right, cool.
Yeah.
All right. So, all right, the whole institutional and algo thing, right? So, every institution that trades, they are not going to, they're not, an institution never wants to overpay for something, right? They always want to pay as little as they can. And because they have the capital and the data, they have better access to be able to do that. So when we're retail trading, you have to be able to find periods of where the cheapest premiums, especially in the options market and the futures market, the cheapest contracts and prices are, because that's where they are always going to be. Right. So in terms of, trading on the monthly, right? We always, everybody here always starts on the monthly chart and probably breaks it down. Right. That's obviously where our biggest buyers are going to be. Now, let me clear this fucking thing up real quick. Right. So we have our massive Corona drop. What do we notice in correlation with that is high implied volatility premiums. If you look at VIX, VIX is trading fucking, the chart's going to look like this fucking blue line here. But we got to periods where people are obviously aggressively selling, right? And we have huge chop, roughly 2 years before, right around, we have Trump's presidency, enters somewhere back here, I think. And then, this is all areas of value, right? So when you see this chop on monthly time frames, whether if it's massive periods of extension, like right here, this is basically fucking 2 years of almost chop, or a year and a half of chop before you see massive volume and a big break. And a big break on SPX like this, that's, this is going to be pushed by mostly institutional. So they're only going to push something when they know they can send it higher, which is the same case up here. It's almost a mimicked fucking move. Regardless, these candles came in because of the coronavirus and the oil war was going on, the Soleimani killing happened. So, that's kind of that's a little difference. This whole thing wasn't based off of just the coronavirus. There was a lot of macroeconomic events happening at the same time. So it all pooled together and the mass selling came. You see these obviously massive wicks on the monthly. People are going to be buying off of these huge levels. So as a trader, you should be keeping in your mind, especially if you're playing long term, and even if these ever play out in the short term. Steph, you remember how aggressive this fucking buyback was during this fucking period. It was insane. The swings where SPY was moving 7% down, then 7% up in the same day. You would literally gap down 7% and then gap up 7% in the same fucking day. It was crazy. So when we're looking at these, right? So, and we mark them, we know this is going to bring probably where the biggest sellers are, right? So I'm going to mark, obviously these are selling, and we know here, big buys, obviously pullbacks. Then there's, big buy here, which was a period of selling. So, there's obviously some sort of supply and demand here. It was, a supply of sellers here, demand for the stock here, and you roll down to the daily, you know, you obviously spot these levels. And when you're playing on any terms of major moving averages, you're going to have people who have, that's either, retail traders coding off of buying off of the 21 EMA or the SMA. There are people that have programs scripted specifically to do that. Same when I see, telling people why I use 200 EMA. Well, the strongest algorithms are on that. You look on the daily chart, you look, bam, huge rip. Comes back down to the same, relative area. And we had marked this area here, that's where the big buys are coming from. And when you're trading price action, right? When it seems too obvious, it's usually too good to be true, right? So this is a great example. How many times have you been trading the market open, right? And this, let's say this is, a 5-minute chart, and this rip happens, the first rip, usually too good to be true. And then the fucking sell-off happens. We have to think in terms of the market plays like a song, right? There's usually some sort of build up before there's like a guitar solo or a verse drops or the beat drop, right? We have to think of that. So the market moves in a cycle, in a system, and other traders have systems built around that. So we know market high here, comes down, comes up to break up another high. It's a second touch. We know 3 to 4 touches, breakouts become higher probability, right? Because normally in that time, if something's taken 2 to 3 times to buy, you've whittled off the people who wanted to hold through that position, or you've eroded option premiums, or you stopped people out in the futures market because you have these periods of dramatic drops. That's where your institutionals are, right? So Ed, you trade with a lot of capital. How many times do you often have calls and puts in the same situation?
Yeah, all the time. Yeah, it happens.
Right. So if you being someone knowing that you can essentially you have much more power to move the market than these guys trading on $1,000 accounts. So you being able to have the leverage to be long and short at the same time buys you a lot of power. So this is what institutional people do, right? So you have, we have this, right? So everyone was waiting for this fucking, let's say the 400 breakout. You know, here was this last drop that shook a lot of people out, that a lot of people went short on. The big candle fucking happened, right? So here, they'll be long the puts, and when people start, okay, I'm getting close to the bottom, they'll load in extra fucking puts just to push the price down. They do this shit generally through the futures market or through options because of the leverage. More leverage, more volume. So they'll push down this, this will, you'll probably place your stop below the next candle, and they'll automatically flush. Everybody stops out. And then they already are loaded in calls. So they'll average down the calls that they're on in hefty fucking size, and then pushes it back up. And then when people start to chase the move, they're watching the level two. You can see when all the one lots, two lots come in and shit. People fucking watch that. If you see one, two, SPX, you won't see it, but, or an SPY, you will, one stock coming, one stock. And then all of a sudden you see a flush of, 200, 300, 400, 500 coming in at the same time. That's all an institutional player trying to fucking wipe everybody out, dropping the retail traders in, or, maybe they're newer institutional players that don't have the threshold to be able to trade with the big boys. So they're always looking to push people out. So when these massive sell-offs come and people are trying to chase that, no offense, Ed, but like kind of like what was just happening at the end, they're just gonna blow the bids out, or they'll drop the bid a little bit lower so people will chase the bid, and then they'll tighten it back up so people will fucking buy, and they'll just stop you out every fucking time it happens. So you see this, and then people are like, oh, it's gonna break 400, and what happens? They're short. They're really long this whole fucking time. They're still long from down here. There's no massive selling that has really taken place, right? And then, so they'll short it back down. And this whole time they're fucking gobbling it up. They're gobbling up all this premium that's fucking falling off. They'll gobble it up. And then people think, oh, I'm buying off of X level. And then they tank it down again just to load up a little bit more. And then when this big level comes in again, they know they've already probably blown multiple people's fucking accounts. Then that's when the fucking massive volume comes in. You'll see it in the futures overnight. Last night, or what happened? Huge fucking gap up because nobody can do anything. Who's gonna short this position in the off hours? Not a retail trader, right? So anytime you're approaching a massive level, right? So this was basically our 4,000 level. You're approaching a mass level. The first touch is almost always going to be a rejection. The second touch, a little probably a little bit different. So you gotta you trade. You really gotta wait and plot it out and sit there and wait for that potential move to happen. You got to be ready to pull the trigger. So that comes to you managing your risk. Can you manage your risk while you're holding that? So that Friday, like when I swung Apple calls at fucking the dead ass end of the day, how many other people you think bought fucking Apple calls then? A lot of fucking people, obviously. It was a big gap up. You weed all this people out that chase starting in here, you're stopping them out, and then at the end of the day, all the big volume fucking stepped in, and here you got your gap up that everybody wanted. So you're always looking to stay one step ahead. And then what is the volatility doing? You need, like, volatility is going to be your guideline always because it's tracking option premium. You should know what's wanting to go on with your option premium because that impacts if you fucking lose or not. And remember, these these moving averages, they're always going to attract buyers. Hold on, I'll open the chart. Hold on, the chat. See you typing in there. Just needed to get that out. Oh, sorry. All right. Let's roll back to SPY. So SPY will always bring in more retail volume than SPX will. Just an FYI. Institutional players will be more likely to buy into SPX just because of the cost basis and they almost always are trading on the monthlies. Normally, a lot of retail traders will trade on the weeklies, and that's usually people will complain like the back end weeklies usually will be a little bit wider. All right, so you really won't see it too much here because these what close at 415, right? But you know, these, 5 lot coming in, 5 lot, like this isn't that's not massive volume, right? And then you're seeing, the bid upticks, and this is still a tight bid for even being after hours, 2 cent wide, you know, very good. So you'll see usually, like this is all retail buying in, and what happens is, right? So if we have what was that resistance or support level, Ed, that you wanted to fucking break? 475. Yeah, or no, prices says it's below now.
Going down.
Yeah, where the fuck are we? Get charts off from the bids. That's all right. But like you'll notice, so let's say, this 475, right? We're gonna wait for the bids to open up, because anytime that these bids open up, you really should start to see, selling pressure come in. But you want the bid to red tick down. You need the ask to red tick down. But if you start to see that, the ask is maybe flying up and the bid's not moving, you might be starting to get bought up, because then maybe you'll start to see the ask getting slapped by people. Still, I wish there was some institutional volume coming on this. Of course, after hours when I'm looking at it, it doesn't want to come in. But you'll see these orders on level 2, and they might not even pop up on here. Your time and sales totally did. These are the ones that are always getting sent in, and you should technically be see these fucking populated. But a lot of these 100 lot, 200 lot, 300 lots, sometimes these can be translated for if someone bought an option and then exercised it. You'll see the 300 lot, or they have the standard 100 set in. I would. That's really annoying. Does TOS let you play back the level 2 on this?
What is it?
Does TOS let you play back the level 2?
Never tried it on demand. You're talking about?
Hold on. Yeah. Let's see. That'll be fucking dope. Oh, we can't even get today's data on it. Never mind.
No. You can't even get tomorrow's. It's like a few days off.
Yeah. All right. Hold on. It's probably gonna fucking lag real quick.
Yes, I'm so down.
What'd you say?
Yeah, I might lag it a bit, but I never used level 2 as well. So I would have done.
Yeah, but I mean, anyways, and just in the scalping terms, just seeing what the bid ask is doing, like, is really your, kind of your fucking can be like your tell all for stepping up on an entry, because you'll watch like Sangucci has a fucking great video on Riot, and I was actually fucking watching it that day. And people will try to control the, because people are watching this. Because if I can slap the bid down, by shorten the stock, shorten the stock, but I'm really long, and then just being able to distribute it and offset the risk a different way, and then shake people out and to trigger a big buy in at a big level, that's a lot of power to have. And institutions do that shit all the time. They take both sides of the trade, because really options gives you the most versatility to be able to do that. And if you're, let's say you're long 100 shares and then you're short 300 trying to pull it down, you can sell three puts, and if the stock price gets there, then you'll sell all your shit out. You can, and if a buyer exercises the put, you've essentially sold your short shares for fucking profit and took in premium. And then if the stock gets bought back up, then you're already long the shares on the other side. And then they'll start selling calls against their fucking shares when, the moves start to seem a little weaker, or, or where they can present fucking opportunity. This day had such a good break, and I really wish I could show that. But yeah, like, even I'm sure Sephi, you said this was riding the 9 EMA the fucking the whole day.
Right,
Like,
21 usually it's been all
yeah.
together. They've been pretty tight.
But even still, like, you can just, in terms of drawing a trend line, like as a trader, right? If stock opens up, you're not necessarily trying to catch this, the morning rip. You're gonna wait for a pullback, pulls back to, basically the pre-market fucking high, let's say. And then, institutions, they're not gonna buy that fucking top, especially in intraday. They're gonna wait for the pullback, because they know how the market makers work, and they know how to facilitate shares, and they want the best fill possible. So they'll wait, buy the pullback, and then the same shit happens. They're doing it all the time. And if they want to hedge any of these gains, they can just, sell a call in the same strike just to hold through, and then dish it out immediately. and then facilitate that way. This whole game is really about hedging. A market maker during this whole rip, right? If you're buying calls, buying stock, and there's nobody on the other side, then they have to sell everybody those calls. So then their negative deltas, right away. Whatever, if you're buying the 406 contract, and they immediately their negative 50 deltas in their portfolio, and they have to buy 50 shares of stock. When do you think they're going to buy 50 shares of stock? They're not going to buy it at the top. They're going to buy it fucking at the dip. So
So to make a long story short, I mean, I don't want to stop you. I'm sorry.
no, go ahead.
I like if we are scalping, right, and we're on a 1 minute, 2 minute chart. What's the telltale sign that we are dealing with, we're dealing with institutions that are, buying and selling. They're like, basically just shooting this thing up. What's the easiest way to tell that? Like I know Jay spots it, and he's good about it a couple of times. What is your method of being able to tell that off the
Well,
chart?
not always. Like when you have massive rips, one, they don't happen every day, especially in an index or an ETF. They're not going to happen every day. Like there's always institutions playing throughout the day, anyways. But in terms of massive volume, like this break that we had, it was a big break of a psychological level. You know what I mean? Like the country's reopening. So in terms of that, like you have to factor everything in. You're having a collapse in volatility, like just analyzing from the VIX. You know what I mean? That in the past couple days, it's really reverted. So you always got to be almost like 2 to 3 steps ahead. All right, I have, this factor, I have volatility reverting. Naturally, volatility reversions is a bullish for an index. And if volatility is collapsing in periods where the stock's not really moving, that's good. That's really good for you. That means something's gearing up. And then, obviously you get the chop still slowly collapsing. Even if you go back to the 20-day chart, you can see it's slowly reverting. And then the big collapse happens when the volume sets in. And that volume
I,
sets in, then you can start to be able to see that, because everything's based off of pricing. Because
but I
we all
understand that's
price their
for the
contracts.
you're looking at daily or a weekly, but how about we're looking at that particular day? We're looking at the minute or 5 minute, like in one day instead of a long term, not a swing but day trade scenario.
Like to try to spot it every day.
Well, if you see it, yeah, I mean, like it's kind of been kind of obvious the past few days.
Right.
When someone's
Yeah,
doing,
it's the truth. The truth is in the levels. You know what I mean? Like they, there's everybody's got their threshold, right? So even in sense of, like we're on the 1 minute chart right now, like before the market opened, people are already watching. All right, I got this level, I got this level, and then where in terms is it balancing with the trend? Because they're always going to buy within the trend, even if like let's taper this trend line just a little bit. Right. So even in terms of like a trend breaks just a little bit. All right, fuck off. Fucking stupid bitch. But like, right. So when like a trend, let's say, we've had this happen before, or if it dips below an like if you're, it's riding the 9 EMA and it dips below and it almost looks like it's going to collapse. That's usually where your institutional guy is. He wants to buy where no one else wants to buy and they're scared to buy. So when the trend rip, comes up a little bit and it dips down and then you kind of get these ugly candles, this like strength candle right fucking here. These are the ones that fake everybody out. It's because nobody wants to buy the blood. They want to buy the glory that goes with it. They don't want to buy up these. So that's it's the red volume out of nowhere that fucking shakes everybody. So you want to try to find and spot those candles if you're fucking buying the dip, or if you're trying to sell the rip. When you start to see the selling pressure from the top side, that someone's going to end up fading this thing with volume in a second. So if you only get these couple candles because you're in an uptrend, there's not going to be as much volume until you get further in the trend. Then the selling pressure is going to get a little heavier. But if you're trying to fade the beginning of a trend doing that, you got to be fucking in and out quick like butter, because that's how they do it. Because you remember that they're trading a high frequency system, so their ability to execute is a lot faster than our ability to execute orders. They can preset fucking everything way better than we can.
right.
And these guys, don't forget, they price all their options out through the Black-Scholes model and the binomial model. So they know if the 1% happens and I lose 30 minutes of time, they know what the option premium's gonna be, which if as a researcher is a lot fucking harder to do. Yeah, like I said, every fucking dramatic drip, and you'll notice it like you all the it tells it in the fucking reversal candle too. And if you're lining it up with the stochastics, you can taper your stochastics to be a little more fat, maybe a little faster in pace to try to catch it. Like period fades and then fucking rips up. That's the way I like to do it because they almost at every like support, if something's leading it to support, it almost always breaks the support and then comes fucking right back up. That's what every time it comes to support, it breaks the support and dips right fucking back up almost 80% of the time in a fucking bullish trend. And then if you're in a bear market, the retest is where all the volume comes in. People will fucking short the top and get the rug pull. But yeah, that's in terms of scalping. And scalp, like the way you scalp is very like high frequency. You know what I mean? That's why you almost have to be hedged because you have to be ready for any potential downside. Like, being if had you bought like, both calls and puts right at the support here, you could have dished the calls up at the top and
Yep.
then fucking rode the puts back down. Then, you're essentially being able to play the facilitating game. And really your main exposure at that point is if any volatility comes down, which on SPY at the point right now isn't really even going to hurt you. Time decay is more so going to hurt you than anything.
So the time decay on a same day contract that still goes by like the minute, right? I mean, how's that calculated when you're buying it in the same day? Not it's not a few days away. How is that changing against you?
So it you buy a lot of in the money. So like, which is like a good thing if you're buying on the same day because you're holding a lot of intrinsic value. So like, if you're buying the 404, right? The odds of maybe SPY pulling back $2 or $3 from where it is, probably isn't going to, the probabilities are more so in your case. So you'll see the theta is probably reduced a little bit more than if you're buying at the money. When you buy at the money, it's going to probably be significantly higher, even though your option moves faster and like you can really, exercise the gamma on it. But you have more time K exposure there. You really just got to pay attention. If you're bag holding something throughout the day, that's when the theta is going to kill you. If you're, in and out like you are, you're buying something and then fucking 5 minutes later you're out, you're really not going to get probably whacked by
Yeah.
theta that much unless the stock really just does not move.
Yeah, I should have been more clear. It's if you're buying the same day and you end up bag holding it for a few hours throughout the day.
Yeah, so there's periods. So there's like from 9:30 to 10, you probably won't feel it. And then fucking closer to like 10:45, leaning into lunch, there's like a small like the volatility really starts to come out. It's not so much the theta. And then like after lunch, the rot really starts to kick in that 1 o'clock fucking threshold. And then at 3 o'clock, you really just there's really not much on the option. You're really just trading the last minute volatility at that point. I call it the potential intrinsic value.
Okay.
Hold on, and let me see these guys in the chat real quick. Hold on. No, laggy as fuck. Yeah, I haven't recorded. Yeah, no, it's recorded. What the fuck was I just talking about? Oh yeah, but yeah, in terms of you being able to run like the strata like that edge and really just the theta being the only time decay exposure. But most of the time, I don't really see you in positions that long though.
Well,
You know what I
the
mean?
only one we had today was a put that I was entered to hedge and ended up getting stuck with it, throughout the whole day.
What was the
And
sizing like on it?
how many contracts?
Yeah.
Mine was like, I think like 200
Anybody seeing this?
contracts.
Did you see this print right here, dude?
Oh wow.
Jesus Christ.
But the funny thing is, when I was talking to Seth about it towards the end of the day, where it was like about an hour left, my delta, once I got into the money again, my delta was still high. It was like 0.8
Yeah.
something, but
Yeah, that's normal. So
you know,
this is kind of the actually let me SPY is oh yeah, no, I am on SPY. So if you've ever read any of like my shit when I talk in terms of like gamma scalping, the gaps in the delta, right? So like when let's oh here we go. Maybe it'll show it. Right? So like, end of the day. right? You see how big, I know this is kind of a shitty example, but this is kind of the
Yeah.
proof in the pudding. So right now, that this option obviously expired worthless. No, it's not worth, it's worth 2 pennies, but it's had an 8 delta on it. Versus this one, you knew at, let's say right before close, you knew that it was going to expire in the money. So then the the closer you get to expiration, the deltas will start to gap and start to rot. So you'll see, like, if we go, in a farther expiration, the deltas due to time value generally, oops, shit, sorry, are generally significantly, meatier
Yeah.
in the back end. Obviously 420 strike. If we go to the 420, obviously in the 2 days to expiration chain, the premium's not even gonna, the deltas aren't even gonna be fucking even close. You get a fucking zero delta. Congratulations. Um, yes, time value will always add that component will always add value, but it's always going to reduce the amount of gamma that you have. And if you're a scalper, the gamma is your best friend. So the short-term expirations are kind of your bread and butter. But when, you're purchasing an option, let's say a 60 delta, when that time value fades off and it's already in the money, the delta is only going to increase because the odds of the probability of that option expiring in the money are much considered to be much higher. Does that make sense?
Yes.
Yeah. Versus obviously, the only reason why the out of the money options to begin with have a delta is because of the time value. But you got to remember, in terms, everything's a probabilistic range, right? So like the way I like to grasp, like you have, ATR is like your average true range. I like to use the method of like the implied true range. And what a lot of, you know, institutional people do and market makers do that are like actively, or floor traders, they always look at whatever the at the money straddle is pricing for the day. So if the market, market opens, they want to see what this at the money straddle is pricing for, because that's a basic call and a basic put. And if we can factor the two together, the option premium pricing, we can generally grasp what a rough range of the stock can trade in. So we would think maybe that in 2 days to expiration, that maybe SPY has the potential to move in a $3.22 range. So like, to me, that's something I like to always keep in the back of my head. And the days I used to scalp SPX, this strategy was actually fucking true. It would almost always hit the implied range. It always fucking happened at the end of the day and it would piss me off. But it almost always, the stock is always trading within some sort of implied range. And through the options market, that's how they're going to price roughly what everything's trading in. And a $2 to $3 move has kind of fucking really been, roughly been the case. $3 fucking gives you a little bit that. And the volatility had stepped up today and it was past the implied range, which is very typical because it moved out of SPY's normal set ranges. So even you guys that are swinging option contracts, like let's say you have a little bit more time, use that little straddle method and you can place your strikes based off the implied ranges. And generally, for most time, it almost is a pretty fucking good strategy to do it. And it won't be as costly as buying fucking at the money or something with a higher delta. That's not the principle for scalping though. Don't use that to scalp. Don't place your strike based off that.
Yeah. It's
Yeah, it
swing.
should be like a $7 range for SPY. 2 weeks out. That's something that could fucking happen.
Yeah, you get
You know,
your
it could move
cruising
$7
control.
down or it could move $7 up. So you could place, buy the
Oh,
407
okay.
and
That's
you still get
interesting.
it.
So I didn't know that's what the bid and ask was based off of. That's interesting. Okay.
Just a lot of reading, man. Like
Huh.
just when you read a lot of shit in books from like, or listen to, you know, even in podcasts, you listen to people who like worked on, the options, like the SPX pits and shit. Um, they pick up, they have their little tips and tricks along the way, and that, that's shit that they use. And I know with the straddle, there's a big quantitative approach that if you bought a straddle where the implied volatility was, let's say, under its historical volatility, you essentially in the long term, if you took that trade 10,000 times, you essentially should be profitable in the long term on that trade. Versus if you had bought an at the money straddle and implied volatility was above the historical volatility, statistically you should lose, if you took that position 10,000 times. Does that make sense? It's like
Yes.
like a quantitative, kind of like quantitative approach. So it just through a lot of reading that, like reading Sheldon Natenberg's option volatility book. Um, a lot of things just being pricing and based off of standard deviation and the math. If you broke down standard deviation in between time frames, it almost always comes out within a few fucking cents of the at the money straddle from the times I've tested. If anyone wants to correct me on that, go ahead.
Oh, nice.
but yeah, so and that's what a lot of and if something's implied a $3 range for the day, that might be where you'll see potential short sellers being. They might be if the stock opens at let's say 403, you might see short sellers at that implied range. They may be wanting to short at that level because there might be, let's say, a reversion in price or a correction in price for the day, not on the long term, but for the day. There are people that sit there and wait for those corrections when something has, let's say, exceeded its range for the day or considered to be, maybe an overbought territory, like right over here, be this 406 price. That may trigger people to immediately go short. So you got to remember, there's always people on either side. They can be on the call side, the short side. They could be neutral. They could be on both. So it's just we just got to make sure that we're prepared to be able to take either side when the opportunity presents. We don't want to be caught fucking in the middle unless we're hedged up to do so.
You guys don't know what straddle is, right? Straddle is basically when you buy a strike and a put at the same. I'm sorry, a call and a put at the same strike price.
Yeah, let me go to the SPY chat. I just got tagged in there. Yeah. I was gonna go on the volatility thing, but I think I'll leave it at that. Leave it at that for right now. There's really so many key factors for institutionals. It's basically a lot of it is them just being on the other side of your fucking trade. I wish one of these days though I want to step in on the live so I want to do like a whole level 2 breakdown because this shit ain't showing the right stuff.
Okay.
Yeah, if anybody has any other questions, I'm gonna head out. I'm gonna go to my daughter's gymnastics class.
All right, really appreciate your time and all the info. A lot of useful stuff, Alec. Thanks
Thank
for
you,
stopping
John.
by.
Thank you.